My name is Aris Katz. I'd like to present to you today how Lucena Research brings additional indicators from proprietary and third-party data providers into our platform KwanDesk. Before I start, I'd like to give you a quick overview of Lucena Research. We essentially bring elite decision support technology to hedge funds, investment professionals, and wealth advisors. Our artificial intelligence technology enables investment professionals to find market opportunities, validate their investment approaches, and reduce their risk in their portfolio. We provide a cloud-based platform, which I'm going to be sharing with you today, that aggregates multiple disparate sources of big data on which we enable an easy-to-use and actionable UI for quantitative research and decision support. What you see here is a diagram that shows some of the data sources that we incorporate into KwanDesk. Essentially, we have our core indicator set, technical indicators, fundamental indicators, and the social media sentiment is really where pyschsignal provides their punch to enable identification of potential action or price actions based on social media sentiments analysis. And we incorporate that into KwanDesk, and essentially that enables our customers to seek alpha, minimize volatility, or increase Sharpe ratio in their investment strategies. It's all done, of course, through statistical, machine learning, and market theory technology. Let me jump into KwanDesk and I'll show you exactly how it's done. What you see here is the browser-based platform that I was mentioning before. It is called KwanDesk. It provides multiple disciplines, multiple modules that allows our customers to run various scenarios and apply machine learning, algorithmic technology for investment. In essence, what you see here, the topology is very simple. You can select a portfolio or an equity basket. And you can execute on that basket the following disciplines, either a forecast, an optimization. You can hedge your portfolio, use portfolio replication, which is a unique technology that we provide at Lucena, and present an event signal analysis, which I'm going to concentrate on today. Let's move on to pyschsignal, and I'll show you how it's used in the context of Lucena's database and research. So one of our modules, as I said before, the event analyzer. I'm going to go quickly and analyze an event that is constructed through pyschsignal signals. You can see here that I have an event that's defined between January 1st and 2012, through the whole year, the entire year of 2012. And in essence, what our system allows us to do is to identify meaningful conditions that historically have yielded a price action either upwards or downwards for a long or a short position in our portfolio. I can show you how it's done. We provide a normalized histogram that shows all the possible values for the universe that we are assessing as to the values that the indicator that we have selected presents. In this particular case, you can see that I've incorporated here Sharpe ratio, which is one of our core technical indicators, with pyschsignal indicators called Twitter with retweets bullish intensity. You can see, by the way, here all the possible signals that we aggregate and consume from pyschsignal and bring completely as part of our existing indicators into our platform. So in this particular case, we chose a bullish event. We're trying to identify price move to be going, of course, upwards after the event conditions were met, and we are identifying the event during the year 2012. What you can see here is a histogram that shows you all the possible values. We chose, obviously, the upper visual range of the potential values. And we can run, of course, over time to see which stocks out of our S&P 500, which is our whitelist universe, have met the criteria that is Sharpe over 1.5 over the last 252 days and had a Twitter with retweet bullish intensity stronger than the average on the upper, quadrants of the various ranges that are available. There are, of course, other presenting indicators as well. Once I run the event study over the course of 2012, you can see how it's performed and what comes back from our engine. So what's happening now behind the scene while I run this scenario, it tried to aggregate all the stocks in the S&P 500 that met the criteria that I've actually defined here in the scan, and identified how their price behaved 1 day to 21 days after the event took place. You can see here, for example, that Fastenal Corporation on January 11th, 2012 was triggered, and you can see that 1 day to 21 days, it kind of ranges between 1.18% to 3.59%. But this is only one case. You can see that Fastenal actually was triggered 7 times during the course of the year, and of course you have other stocks as well. Now, what you see on the bottom here is an aggregate of all the events that took place that met the criteria during 2012. There's 303 of them. And what was the average price move from 1 day to 21 days thereafter? You can see that in the average, there's definitely a bias to the upside as you move along the number of days. And you can see here the margin of error that ranges from 93 basis points to 3.58% as you move on. It gets wider, of course, because there's obviously higher distribution of potential price moves as the time frame gets longer. But what's important to see here is that there's definitely bias to the upside once we identify the event conditions during 2012. What you see here, by the way, is an analysis that shows us by sector which sectors are more prone to move in the positive direction and which ones actually have a mixed result. You can see, for example, energy or material has a very strong bias to the upside. Consumer discretionary or industrial are not so clear. You have lots of reds and greens. So visually, you can see which sectors you may want to concentrate on as opposed to the entire universe. Below that, you can see here a little chart that explains more visually how the data is distributed. You can see here this vertical line represents the event date. The 10 days prior to the event date are depicted here by this mean line that aggregates the behavior, price move behavior relative to the market 10 days before the event date. And what you see on the right side is a distribution of price moves after the event date up to 21 days. You can see, by the way, here that we've highlighted a sector that we are most interested in. And you can see that the mean line absolutely shows clearly a bias to the upside as you hold on to the stocks up to 21 days. What you see on the bottom again is the same aggregate result. You can see that 21 days later, you have on the average a 2.39% price increase with a 3.58 margin of error. So there are, of course, some situations where you're going to be losing money, but the great majority of the conditions that were met during 2012, this is just 1 year, obviously show a very strong bias to the upside. Now, what you see on the right side here is additional indicators. Some of them are other pyschsignal indicators that are recommended by the engine that if we add them to the event scan, they're going to reduce the number of events, which obviously was going to hurt the significance of the number of events, speaking statistically, but at the same time, it's going to give us a very strong bias to the upside even more than what it is now. For example, if I add the Twitter no retweet bullish intensity to the event study, you can see here that it'll increase the return from 2.39 21 days to 2.65, and it'll reduce the number of events by about half. 43.9% of the events are going to match the new criteria. I'll leave it alone because this is strong enough to backtest and see if those conditions are really will hold out of sample. To do a backtest, we would have to basically execute a historical simulation of what happens if I actually bought and traded every time a signal was met between January 1st, 2011 and March 31, 2015. This is basically multiple years out of our sample year, which was 2012, in which we defined the event and refined the event. So when I run the conditions during that time frame, you can see here that I can simulate the transaction cost. I can simulate how much we are going to allocate out of our portfolio for every event instance. How long are we going to hold to the positions that we simulate buying, and how many positions per day, and other type of configuration, including what is our stop loss or stop gain, max gain conditions if we want to really truly simulate a complete comprehensive strategy. What you see here is the results of the backtest. You can see in blue is the benchmark, which is the S&P 500. The orange line represents the strategy itself. And you can see clearly that we have a strong performance even out of sample during the years that have not been tested, which is not 2012. There's also a more visual approach in the form of a PDF that can be shared with customers, constituents, colleagues, essentially, that shows how the benchmark performed relative to the strategy on a year-by-year basis. Remember, this is a exposure-adjusted benchmark. So when we only allocate 1% against the strategy, the benchmark is also only allocating 1%. So it doesn't show the exact full value at the benchmark in all times, which is a better way to compare our strategy with the benchmark. And you can see here performance attributions such as risk return analysis, correlation to sectors through beta, how diversified you are. And there's a lot of other attributions that we capture and report on with regards to the strategy. Once we are happy with what we have received, this is, by the way, a pretty good result, we can actually paper trade it and eventually incorporate that into our trading strategy. This is pretty much what I wanted to show you today. Hope to see you around soon, and hope to share with you additional cool features of KwanDesk. Thank you so much.